So here we are tonight with Fred REIA, and our guest speakers are Tom and Michele McFie. And we are actually going to be posting this to YouTube too. So if you are watching this on YouTube, please like and subscribe for further videos. So we did actually talk about our group poll today was about squatters. Rick actually mentioned about squatters, so that was the question. And then we are going to go right into this. All right, I'm going to share my screen. There we go. So, like I said, this is Fred REIA. We actually are in both Florida and in Virginia. I'm a broker in both places, a real estate broker in both places. So we do that. It's myself and Rick are the group leaders. We actually own HomeDream Realty and Property Management in Fredericksburg, Virginia. So we can help with that there. And then we have HomeDream Property Solutions in Florida that handles short-term rentals. So we have short-term rentals on the Gulf side and in Fort Lauderdale. We do mid, long-term rentals up in the Virginia area. And we have them in multiple states and things, but places we can help you is in Virginia and Florida. So if you have any questions about that, that's great. We actually started investing as house hackers, where we lived in a portion of the house and rented out the rest, or rented it by the room, and we still do that. So Rick, did you want to add anything?
Yeah, our latest foray has been into the short-term rental space, because prices being so high, that's where we can best cash flow. And so I'm anxious to hear from the group in terms of what you guys are investing in as well, and also to hear from Tom and Michele in terms of what they're seeing in their space.
Very cool. Very cool. So actually, we will be going on the next real estate investor cruise in February. National REIA does have a cruise in February, the 2nd to the 9th, on the Royal Caribbean Symphony of the Seas. And that is sailing round trip from Miami. So the best thing about this, and we're actually next month, we're going to be doing some ahas from our last investor cruise. The best thing about cruising on these educational type things is on the sea days, you don't really get to relax. You're actually in conferences all day learning and networking, and then you can talk with people at dinner. So if anyone would like more information about this, I will definitely be putting it out to the group, but we'd love to have you.
And we'd like to see you too.
I'm sorry?
We'd love to see them too.
Yes, definitely. See you in person. So the disclaimer is that the topics discussed are for general real estate educational purposes only and not considered investment advice. Rick and I can help you with real estate investing, purchasing, and with property management, but that's not what this is about. Tom and Michele are here to only give us some educational information, and to always seek your own individualized experts for an attorney, an accountant, investment professional, or anyone else in those different places. All right, so we do have the upcoming speakers. Rick is actually going to introduce Tom and Michele here in a moment, but we do have our in-person networking meeting on April 25th at Wegmans. And then next month on the 7th of May, which is a different date than normal, we're going to be talking, like I said, about the ahas from that investor cruise. And then the next one we meet, the in-person networking is the 4th Thursday of every month. And then June, Wendy Sweet is going to come back to us. She's actually came to 3 years ago about the, we had her on 3 years ago. So we're going to have her back about financing your deal with the new normal. And then Thomas, you said you had a question. What's up?
Yeah, so the in-person networking at Wegmans, is that, so we've gone the last 2 months and nobody from the Fredericksburg REIA has been there. Is that normal, or is that, are we going to the right place?
So the thing is were you there by yourself then? So the thing is
No, actually there was a group of like 8.
Right. And the Fredericksburg REIA, that is the Fredericksburg REIA. So we could be there, meaning like Rick and I could be there, but we also, lately we've been in Florida a lot because we've been handling these issues with the short-term rentals in Florida. We were installing a pool. We bought that triplex last year and we were installing a pool and some other things, but we will be there soon. will actually be coming up at the end of May. So we'll be there for the June, for the June meeting and the July meeting, the August meeting, and the the June, July, and August meeting will be there. So, we look forward to seeing you then.
I think, and I also would like to stress to Tom, it's an opportunity to meet, like-minded people, talk about your different experiences. There's no training involved in that. It's just a networking, informal networking group. So that's the purpose of that, is just to help facilitate that.
Yeah. So that's what we do, is we facilitate that. We're back and forth between Virginia and Florida. So sometimes on the third or the fourth Thursday, we're in town, but sometimes we're not. But we will be on those 3 that I just mentioned. Definitely. Okay. So we look forward to seeing you then.
Thank you.
No worries. No worries. Okay. So what we want to say is we want you to live like nobody else lives now, so you can live like no one else lives later. That's the whole thing. So, Rick, why don't you go ahead and introduce Tom and Michele?
All right. Tom and Michele founded a company in 2007. That's a short 17 years ago. Wow, time flies when you're having fun. It was to help people keep more of their money and grow their wealth and have financial security. And help me if I pronounce this right. Is it McFie or McFie?
McFie.
McFie Insurance is family owned and operated, and they do a lot of different education vehicles. They do YouTube. They have a YouTube channel. They have written a book called The Prescription for Wealth: Winning Your Financial Game and How to Build Sustainable Wealth. They also wrote a biblical guide to personal finance, and they host a weekly podcast called Wealth Talks, along with their son, John, who's a registered investment advisor. And they're here today to talk about how to use a whole life insurance as a financial tool for their investment strategy. So please welcome Tom and Michele.
Well, thank you very much. It's good to be here. And we always like to talk about what it is that changed our life, and that is whole life insurance. So Michele was a school teacher. I was a chiropractor. We've raised 8 kids, and all of those children are happy that we bought life insurance on them when they were young. So because they're using that to leverage that, just like we're going to share with you today how to do it. So we're just going to cover some basics, and I don't want to sound like we're going over redundant things, but we have to understand a few things before we understand how life insurance really can be used. So let me see if we can share this screen here and get it going for us. So can everyone see my screen now?
When did you buy life insurance on all your kids? Well, how old were they? Were they under a year?
My youngest one was under a year. My oldest one was 15. And so we were able to buy about 4 policies on each of them as they grew up, and use that as a savings vehicle for them instead of doing like 529 plans and other things. So they've been able now to tap into those resources, start their own businesses, buy their own vehicles, invest with that money as they choose, instead of being forced to take money at the government's mandate for college education.
I love it. So I'm going to ask you some personal questions. You don't have to answer them, but I just
hold on, Rick. I can't see your screen. That was the question.
What's that?
Their question was, can we see their screen? That was their question.
I can see it. I'm just excited to get into this.
I'm looking forward to your questions too.
So here I am, at a ripe old age of, I'll call myself on the back 9 of the 18-hole golf course in life. And I'm now in a position that I have money, and it's kind of too late to buy, life insurance for my older kids, right? My 30-year-old kids, but it may not be. But I was thinking of, if I were to look at my nieces and nephews that are, and I get something at a very young age, like you did, that's very affordable. What's a good number to set them up for? Like, is there a number you would recommend if money is not an object, so to speak?
That's a good question. We get
That's
it
a
a lot.
loaded question.
It's a loaded question, but we have to understand that the IRS is very interested in how we fund life insurance policies on other people. And so is the insurance company. And they're not going to let you buy insurance on a nephew or niece unless you're insured yourself. Very rarely, because life insurance companies hate risk. And they don't want someone buying a policy on somebody just to collect the death benefit. And so even buying life insurance on our own children, Michele and I had to have 50% more death benefit before we could buy a death benefit that was 50% of our death benefit. So a child can have 50% of the death benefit the most insured parent has.
I see.
Now,
Got it.
there's
Got it.
exceptions to every rule, okay, David? But that's the guidelines that we start with. And if you're not insurable, now that's a different story altogether. So then we go down that avenue. Does that help?
Gotcha. Yeah, no, it does help. I was just thinking of it as a gift. I think mine was bought as a gift for me, you know, on my whole life policy. And I'm sorry to make this call about me, but I'm just trying to apply it for everyday life. Somebody bought me a gift when I was a little young wiener snapper. And so now I have that, and I was able to roll it over, and now I have a pretty substantial whole life policy. And I'm just thinking, gosh, if I could do that for my nieces and nephews and give that back to them as they get older, they'll have this like you did for your kids. That's all. I'm not trying to profit from
Well,
their
let's
death.
let them tell us what their basics are. And
Okay. Thank you for your patience.
I'd
Thank
love
you.
to address that just a moment. That's a great idea. And you can be the payer on a policy.
Yeah, that's what I want
And
to do.
those kids would be the insured, their parents would be the owner and beneficiary, but you can be the payer. We do that all the time with grandparents purchasing policies for their grandkids.
Awesome. Okay, great. That's so great to know. Thank you. I'll try to be quiet.
Or even godparents buying it on their godchildren.
Yeah,
So, yes.
exactly.
So we're just going to cover some basics here. And what we're really talking about, and probably most people have heard about it, is the infinite banking concept, which is using life insurance as a place to store money so you can leverage it and not lose the growth on your money while you get to use someone else's money. And it's really keeping the cost of capital at a bare minimum instead of losing it. And so when we take a look at, and I'm trying to advance my slides, here we go. This is a different platform than I'm used to using. So this article appeared in Fortune magazine in 1993. I would encourage everyone to go and Google it and read it, because this article was what made companies like Coca-Cola, Johnson & Johnson, Cisco, Briggs & Stratton, a lot of companies were not considering their own cost of capital when they were making investments. They understood that if you sold a bond or if you had stock, that there was a cost to that. But when they dumped their own money back into development, research, or growth, they were not considering that cost. And that's really all we're doing with the life insurance cash values as well. We're using that as a storehouse so that we don't lose the cost of our own capital when we use it.
So a lot of people will pay cash for things and then they don't have any money because they just bought something. So they have to save up the money to have money again. Or people will go out and buy on credit and then they got to work to get back to zero for what they've already purchased. And they do that over and over again. But when we use the life insurance, now we can leverage our savings to purchase that item while paying ourselves back. And as we do that over and over, it increases the amount of capital that we have. So that's kind of the basic premise that happens with using whole life insurance as a financial tool, saving, spending, and recapturing the money that we're spending.
And of course, when I read the infinite banking concept, becoming your own banker, I realized that you never really come back to zero when you spend your own money or when you finance, because what happens is you've lost time and you end up losing interest. So considering the cost of capital, the cost of capital is money lost when using your own money or other people's money. So let's take a look at that. Everyone knows that if you borrow $10,000 and you pay it back over 7 years at 5%, you're going to end up paying $12,097. And that's an interest cost or a capital cost of $2,097. But when we go to use our own capital, people don't consider the cost of their own capital. And if we had $10,000 that we spent over the next 7 years, even if we were just earning 3% on that, we've lost $2,298. So we can lose more money using our own capital than other people's capital. And that was new to me because I was a cash guy before I got into this. We paid cash for our second house. And I thought, yeah, I've won the victory. We're not going to be paying interest to anybody else. But we still lost money. And that was really disturbing to me because I didn't like losing money. So this is what a lot of people do, and there's nothing wrong with this. If we borrow someone else's money and make an investment, even at the same interest rate that we borrowed it at, so we borrowed $10,000, make an investment with $10,000, we end up with a $4,071 profit at the end of 7 years. But then we've got to take out the cost of capital. That leaves us with about $1,970 some dollars of growth. So what we're advocating is, what if we had a place we could store money, which we do, it's life insurance, where we could collateralize our savings or our cash value in the policy, still earn the growth the policy's given us, make the same investment here in the middle in the green, pay the same cost of capital to the insurance company. Then what would happen is we would reap the gains, we would reap the interest on our own money, we would have the return of our savings, we could subtract the cost, and we would end up with a lot more money. And that's what we've been able to do. And that's what we want to share with you today, because this is so amazing how it's turned our life around from wondering, how are we going to put our kids through college and pay for their weddings and all the things that parents want to do. And now we have an abundance of capital simply because we managed it different. And the trick is understanding the power of life insurance. So I was 45 when I first bought a policy like this, and I'm now 60, almost 64. But this is a 10-year window in this policy. And there's a lot of numbers here, so let's just break them down. In year 7 of this policy, I had paid $150,672 in premiums. My cash values that I could leverage at that time were $156,924. That's this number here that I borrowed and this number here that I had not borrowed against yet, added together. And so we are paying premiums on this policy still yet of $10,224 a year. And so from year 7 through year 16, those premiums plus the money that I had not borrowed out against the policy grew to be $156,000 right here. You can see that. And that's a 4.6% return that the policy's doing just by me paying my premiums. And now if we look at, oh, I've taken a loan out of here, so now I have to pay interest to the insurance company. And so my interest and premiums every year totals $16,781. And we can see that column right here, net cash outlay. All right. And then what have I done with the 137? And this is where real estate still plays a huge role if you're a real estate investor or whatever you're investing in, because whatever you're earning there now gets compounded. And we've turned that 137 into 312,000. And now we get to add the policy plus what we've done with the investment. And that's 468,567. So we just multiplied what we were able to do by having the life insurance, because our capital was still there. And if I had paid this loan back instead of just keeping it outstanding, then my returns would have even been higher. But as long as my capital's invested and making a good return, there's no rush to do that because a life insurance policy loan is an interest-only loan that's due once a year at your policy anniversary, which it's kind of hard to come by interest-only loans these days.
So on that return, Tom, that you had, that 4.6% return just on the
Yes.
basic insurance, that's relatively, that changes, right? That's not a guaranteed annual return. It really depends upon how good of an insurance product you have invested in, correct?
Well, initially there is a negative return because you're still overcoming the cost of the insurance.
Okay.
And so as a policy gets older and older, that internal rate of return gets better and better. Because I was just talking to a client the other day, and this is the last slide in this presentation. He says, "Why should I pay my $4,800 premium this year?" I said, "Because it will give you 58% more cash value than what you paid in premium."
And that didn't happen in the first year, the second year, the third year, but he's at year 13 now, and that's happening.
So he was saying, well, I can earn 15% on this money, and that's great. That's a good return. So if he invests $4,800 and earns 15% on it, or if he can invest $7,600 and earn 15% on it, that's an 82% difference in what he's going to take home.
Right. I see.
Mhm.
Interesting.
And so once we build these cash values up so that they're growing faster than our annual premium, which usually takes place in about year 5, now we've got something that's taking care of our money better than average, while we get to go and leverage it and use it someplace else and still earn that better than average return.
Mm-hmm.
So something Nelson Nash used to talk about is how when we're buying a life insurance policy, we're really starting a business. And just as in real estate, you buy your first property, that's not your most productive year. As you continue to go along and you have properties that are, you've already paid off some of your startup costs of investing in real estate, just like in a business, you start paying off your startup costs, then you're getting more profits. And so the same thing is true with the insurance policy. You've got to overcome the cost of insurance initially. There's benefits to using it. You'll have cash value right away, but it takes a period of years to increase the profits all along. And so every year it's going to get better and better. It's guaranteed that they have guaranteed values that prove it's going to get better every year.
So my illustration here on my first policy is when I didn't pay the loan back. So let's look at someone that did, okay? This is a policy that was started, and they're actually in year 10, which is year 1 on this example, because that's when they're going to start using it, all right? And they have $236,662 of cash value. Now, this policy is what's called a paid up policy. That means there's no more premiums due on it. The policy is done. It's going to do what it's going to do for the rest of its life without any more money coming out of the policy owner's pocket. And they wanted to borrow $200,000 to actually make a real estate investment. So they did. And they just said, well, I'm going to pay that loan back at a little over $2,000 a month, which they did. We can see here in the red. And at the end of that first year of repaying, they have $62,687. Well, if they hadn't have been paying the 24 back, there would have only been $36,000 there because they borrowed 200 of the 236. But even though they paid the 24 and 36, they add up to less than 62. So we're seeing some policy growth happening in this, even while they have a loan out. Notice though that the death benefit was reduced, because if this person dies with a $200,000 loan outstanding, the loan is going to be completely paid off, and what's left is going to be paid to the beneficiaries. Now, as they pay this back diligently over the next 10 years, notice here in the last month of a year of their payment, they only put in $20,351 in. And the reason that is if they put the whole 24 in there, the policy would be overfunded because that would be extra premium considered, and this policy's paid up. So it's not going to accept that extra $4,000. And that's all due to because the policy has been growing even while the money has been leveraged against it. And so let's just look at some numbers here. The total growth in this policy is from here to here. That's 303,000. Okay. Total loan payments, if we add up all the payments here, it's 236,000, which is less than if we had a conventional loan at 3.5% and much less than if we had a conventional loan at 5%. Because we don't have the tailwind of the policy's growth helping us along. Another way to graph this is to say, okay, this is what the policy loan cost us. This was the policy's growth during that time. This was the asset that we purchased, and hopefully it was an appreciating asset. Okay. And if we combine the growth and the asset together, then we have something that is worth much more than what we paid for. Okay.
Are there rules on what is allowed to be bought or what can be borrowed and used for?
There are no rules on why you need the money. All you have to do is sign a paper and say, I want my money. I want to leverage my cash value. So it's a signature loan, which means that you don't have to wait through underwriting.
Well, it's your money, so to speak, but it's...
That's right.
Yeah.
And the reason that the next two slides are going to explain this a little bit more, but cash value in a whole life insurance policy develops because there is paid up insurance in the policy. So think of it like a mortgage payment. Every time you make a mortgage payment, you own a little bit more equity in the mortgage. And in life insurance, that equity growth is guaranteed, whereas in other types of investments, it depends on what the market's doing sometimes. Okay. So let's look at a typical whole life insurance policy, the way someone traditionally would sell it to you. And we're going to see that cash values grow very slowly. In fact, in year 1, there's no cash values. And in year 5, there's a little bit more. And by year 20, you're getting some cash values. But when we look at the premiums that we've had to pay for this, the cash values never exceed the cost basis of the policy. And this is why people say whole life insurance is not a good place to store money. So what Mr. Nash in his book, Becoming Your Own Banker, taught us is let's use a paid up rider. When we fund a paid up rider to its maximum capacity that the IRS will allow us to, we have cash value in year 1. And we have cash value in year 1 that is almost 60% of what you paid in premium, sometimes even more than that. All right. And we see somewhere between year 10 and year 15 that the cash value exceeds what we've had in cost basis, the premiums we've paid. And from then on out, the cash value continually grows because the cash value guarantee in a whole life policy says that the death benefit and the cash value have to equal each other when the contract matures. And so it's just the point in time when the cash value exceeds, and we just kind of accelerated this process by adding the paid up rider instead of waiting 10, 15, 20 years before we get cash value enough to really leverage. Another way to look at that is let's just compare a $1,666 mortgage payment to a $1,666 whole life insurance premium. And we're just going to look at the cash value in the life insurance versus the interest that would be paid and on a 6.57 mortgage, okay, rate, mortgage interest rate, okay. So in year 1, we make our payments, and the interest and the cash value are about even. But the difference with the insurance cash value, that's money we can use again, whereas in a mortgage payment, that's money that is lost to us. That's not a bad thing if we understand the implications. It's just that we're just doing this comparison. By year 5, there's been more interest paid than cash value developed. So the cost of a mortgage is going up where the cost of the insurance is going down if we look at accessibility of funds. And by year 10, it's no competition at all. There is much more cash value in a life insurance policy. So you've regained all the interest that you would have paid in a mortgage plus more if you just spent the same money on life insurance. So we're not saying don't buy mortgages, don't buy real estate, because that would be foolish, because real estate's a great investment. We're saying, let's think about this and let's not just put all our eggs in one basket, and let's consider setting something up that's going to benefit it for the rest of our life. And maybe we won't, sometime in the future, won't feel like managing properties. And where is our capital going to be then? Okay. Well, we've got a client in Vermont he's in his late 60s. He's been doing real estate ever since he was 18. He is now selling his real estate and buying cash value life insurance because he says, I may want to get back into real estate. I want the cash value, but I just don't want to be involved so much anymore.
And also, when we look at this, we're storing up, we're producing cash value there that a real estate investor can easily access to go purchase a property when it becomes, a great sale, a great time to do that. Where if you've got property that you're leveraging, maybe it's not a really good time to leverage that property in order to go make that real estate deal that you want to do. Maybe the interest rates aren't what you're liking to see right now. And so turning to the cash value life insurance, you can get it quickly. You can choose how much you want of it. And the interest rate is better than what's available right now. So it gives you options.
One of our clients is a real estate investor. He does commercial real estate in Illinois. He's an anesthesiologist by trade, and he had leveraged his life insurance policies that he owns with a bank because interest rates at the time, 5-6 years ago, were lower from a bank than they were with the insurance company. Well, this last 18 months, the bank interest rates have accelerated to the point that now they're 3 points higher than he can get it from the insurance company. So what he did is he sat down and he went to the bank and said, look, I want to pay this loan off, but to do that, you're going to have to you're going to have to release collateral hold on my cash values. And when I do, I'll pay you cash. So he just transferred his loans with the bank. Now he owes the insurance company. And now as he pays those loans back, he's recouping the principal and the interest instead of just owning the property. He's very happy about that. So
Interesting.
So this is the question that you referred to earlier, Rick. The client says, hey, I'm making 15 to 25% on my investments. Why should I pay my $4,800 premium this year? Why shouldn't I go invest it? Because the policy, if we look at all the premiums I've paid over the last 13 years, have only made between 2 and 3%. And that's because of the cost of insurance. We're overcoming that cost of insurance in the first 10 or so years. My answer was this: paying $4,800 in annual premium this year will increase your capital access by 58%. Instead of having $4,800, you could have $7,600 to invest with.
And that was because on the illustration, it showed he paid the $4,800 and his cash value increased by $7,600 when he paid the $4,800.
That's correct. Investing this, he would generate another $1,140. Where investing $4,800 at 15 would only generate $720. And to create $8740 over 12 months, just using $4,800 would require an 82% return, not 15. Now, on top of this, this policy is paying dividends. Now, dividends aren't guaranteed. Dividends are the company sharing their profits with policyholders at the end of the year. So the type of insurance we use is always dividend-paying whole life insurance. It's usually written with a mutual company, almost exclusively now. And the dividends that he is getting paid at this point would recover almost 50% of the interest he's paying to the insurance company for this loan, this $7,600 loan. So that reduces his interest rates down even further. And then the interest he does pay, he can write off on his Schedule A 1040 because it was an investment risk. So now he's getting a deduction for that. So it reduces the amount of interest he's paying as well in the long run.
So he really thought he was only getting a 2 to 3% rate of return, but that's because he wasn't looking at it properly.
And we go through this because if people just look and consider an insurance policy as an investment, they're going down the wrong path. Insurance, even the Supreme Court has ruled in 1911 that life insurance like this should be considered property, not an investment. So this is our property. We get to manage it, and having it is a great financial tool, which lets us keep the return on our money while we get to invest it and keep our money and recover part of the interest that we would pay for using money.
Is this something, Tom, that Michele, would this be something good for at any age? Or, do you have a recommendation to our audience to say, hey, if it's too late if you're 65?
Well, I'm almost 64, and I'm not opposed to buying another insurance policy, although I'm 8 on my own life already. Okay.
eight on life insurance policies on you.
But here's the key. A life insurance policy should be purchased when it's comfortable and affordable for you. And depending on where you are in your lifetime, it might be that whole life insurance isn't something you should buy right now, but you should prepare yourself to be able to buy it. So we also really like people to look at something called convertible term, especially when they have a young family or they're buying their first home and they're kind of stretching their limits just to make sure that they can keep this house. And if something happened to the breadwinner at that time, that
Right.
would spell devastation to that family.
Right.
And so everyone should have some coverage, and that's what term insurance does. But term insurance that's not convertible is a waste of money because 99% of it never pays a death benefit. So you're just enriching the insurance company. So if you get a convertible term and you start out and it's covering your needs, well, as it becomes more comfortable for you, you can convert part of that term to whole life. And you can do that for as long as that term is viable. And slowly you can convert that policy to a whole life policy. So is there an age limit? Absolutely not. Is there an age limit when you should buy it on yourself? Probably, because by the time we reach 70, the cost of insurance will be so expensive that we personally will probably never see more cash value in that policy than what we paid for it.
Mm-hmm. Okay.
And then I say that in tongue in cheek, but even at age 70, life insurance is a good investment if you're looking at creating a legacy.
Because I'm thinking of some of the people that listen to this message, and they have young kids. And again, that's where my head was at. And I'm like, it's so affordable at such a young age. It's so incredibly amazing how little I'm paying to maintain this policy. I'm not spending a whole ton of money, and people can invest, like you said, in their legacy, buy the policy on their child or something like that. Again, the grandparents can do it, or however, I'm just thinking I'm rich Uncle Pennybanks, and I can do it now where it was really hard, when I was younger. And so, helping somebody get a leg up until they get responsible enough, and then just turning it over to them. That's how it was for me. I got out of college and they turned over the policy to me, and here I am like, okay, what do I do with this thing? But I'm to this day, fast forward 35 years later, I'm still, chugging away with this thing. And I just think that other people could take advantage of it. on their child, or, giving them a leg up like you did for your children. That's all.
I think that's great. One of the books that we always recommend our clients read is The Richest Man in Babylon.
Oh yeah, that's a good one.
The Richest Man in Babylon tells us we should be keeping 10% of everything we make. 20% should be for investments, or if we have bad debt, then that 20% needs to go to our debt to get rid of that first before we invest. And 70% is left for our lifestyle. And if we do that, that's a good starting point. But there comes a point in time where if you're spending 70% of what you're generating, you're just living way too high on the hog.
Yeah, it's not a good thing.
So, but if you start with that discipline early in life, then you can sock away a lot of money into cash value life insurance. And now you've set yourself up for later years when you may not be able to work as hard and as long as you're working right now.
Mm-hmm.
A 10-20-70 rule is really, really powerful.
And it's exciting because when you put that 10% away into your insurance policy, you are gaining cash value that you can use to improve your business, do investing, whatever you are doing, you get to do both at the same time. Well, not just both. A third thing, you get to provide coverage for your family. So it's a great tool. It has multiple uses all in one. Very exciting. And, I would say many of our clients own life insurance on their own lives, but then also on their children because they understand it as a financial tool. We're showing them how to use it and they see the value and they're able to afford that maybe when other people wouldn't because they're starting to understand these principles. So that's exciting.
Mm.
So we find as we talk to real estate investors and developers around the country that they talk a lot about IRAs and 401ks and Roth as a way to use that capital. And that's great. But with life insurance, there's no limitations on how you use the money like there is in those vehicles. So it actually can be even more powerful because of that.
I never thought of it that way, but yeah, interesting. Are there taxes when you take the money out?
As long as we borrow the money, it's considered a loan. So just like if you borrowed money from anybody else, a loan does not trigger income tax. Now, the growth on money that you would invest could trigger some either capital gains or income tax, but the money that you borrow is never taxed.
Well, and let's say too, that we're talking about whole life insurance that is not just any whole life insurance, but we are following the IRS guideline to make sure that it's not considered a modified endowment contract. Because when you borrow from a modified endowment contract, yes, you will have tax implications, but we're designing the policy in such a way to give the highest cash value and not cross that line with IRS.
Okay, thank you.
And of course, the cash values and the death benefit have judgment proofness in most states. Every state has some are more than others, but there's a lot of states, it's 100% judgment proof. So if you get a judgment passed against you, it can't have a lien attached against it.
Okay. What about, can you buy in policies in an IRA? I don't know if you what the advantage would be, but I'm just thinking of the tax benefits of, how we do Roth and things like that, where it's tax-free, whatever gain you make. But I'm thinking, okay, so if you bought the insurance policy inside a Roth, then you'd be sheltered from the gains. And again, I don't know if it's even possible.
It is possible up to a certain amount. The same contribution amounts that you can contribute to a Roth would be what you could do that. You can do that, but there's really no gain in doing that because now you've cut your liquidity of using it for other things because the Roth rules are going to apply to the money that you're going to access.
Okay.
So, for example, if in a Roth, if you borrow from that Roth to fix up a rental, you can't put the sweat equity into it. None of your family or you can live in that rental. Otherwise, you've violated the Roth agreement. So with a life insurance policy, there's no restrictions like that. Where if you put life insurance policy in the Roth, now the Roth overrules the rules regulating the life insurance, and it becomes Roth money, and it has to be used accordingly.
Gotcha. Okay. Interesting.
Now, there is a place where people buy life insurance and annuities in what are called 412(e)(3) plans, but that's a completely different subject. And it's for people that are very high income, that don't have very many employees, like less than 5. And it's a way to not have to pay tax on about $350,000 of income if your income is high enough that you can divert that into annuities and life insurance. But that's money then that you would not be able to touch until you're 59 and a half and retire. And then it would be subject to income tax. So
I see.
take out
Okay.
the required minimal distributions.
So if people wanted to get a hold of you, what would be the best way to do that?
Well, glad you asked. We have a little code here that we let people scan. It's easier than trying to remember a telephone number. But if you want to write down our telephone number, you can do that too. It's 702-660-7000. And this little code here will take you to Michelle's calendar where you can schedule your own appointment. Or if you want us to call you back, we'll be happy to do that. We like to talk to people. There's no charge to talk with us because everybody's different. Everyone's in a different spot. And so we have to start where you're at, and we just build from there to see if this is going to be something that's valuable for you or not.
Okay, great. All right. Anna, did you have any questions, or did you monitor the chat?
No, I was wondering, we should see if anyone else had questions. I wanted to let them know that we did put their information in the chat also, so that that would be there. Does anyone else have questions of Tom and Michele? Didn't know if Thomas but I actually have read both of those books that you were talking about. The one with Nash of it was
Infinite Banking.
Having your own baker.
That one, and also The Richest Man in Babylon, and they were both really good. So, but yeah, they're saying good presentation, thank you. But it's nice to have it defined to you and help, because it's kind of confusing when you don't know.
It can be, yes.
Yeah.
And then you've got the people out there that are trying to make it better than it is. And that just hurts everything, you know?
Right, exactly.
I always tell people, you're experts in other areas. We just speak insurance-y. And so it's our job to explain to you what is happening, and we'll show it to you. You'll be able to see it, and you may not be able to tell someone else all about it, but you'll be able to see it. It's got to make sense.
Exactly.
And that's what we help people understand.
Well, and that's why I wanted to come on, so people could see different ways, and that's kind of what we're about. We're just trying to help educate people of different ways that they can use different monies to invest in properties and real estate and things like that. So that is why we do that and try to have different people on. So, so I don't have any other questions. Rick, did you have any other questions?
Well, I was just trying to say that you don't know what you don't know. And, when I was given this insurance policy, it was bought when I was a baby. And I think it was my grandparents, or I don't know how I got it, but my parents gave it to me. Somehow I got it after my grandparents passed away. And I don't know, I'm trying to give people a roadmap on what they can do if, they have young children. It's very affordable. Is my impression, because I know how much I'm paying for it now, and it's very little. But I don't know if all whole policies are the same. And I think that's where you can add a lot of value on discussions like your one-on-ones, and setting up a meeting with Michele, what you have to offer. Because like I said, I don't know what I didn't know. And like I said, I think I got this right after college. they said, okay, well, now that you got your job, you're responsible for this. And I'm like, well, okay.
You know, Rick, one of my sons just came to me the other day, said, Dad, look at this. I paid $800 in premium this year and my cash value increased by $1,300.
Nice.
There
Nice.
you
But he
go.
didn't know. You're not born with this stuff coming out of the womb, but you
Yeah.
took advantage of this gift that you had, knowing planning, legacy planning, really. And so I'm just hoping other people see the value, that, hey, this is not just for you. It can be for you. Of course it can be for you, but it can also be for your heirs and your children.
Absolutely. Thank you so much for having us. We'd love to talk about this. This is really what we've dedicated our life to once we understood the truth about it. And so anyone wants to contact us, we're here to listen.
Appreciate it. Thank you, Tom. Thank you, Michele.
Thank you, Rick
When
and
I
Ann.
send out the recording tomorrow, I'll make sure to include your information too, so that if anybody has any questions, they can definitely, reach out and contact you and get more questions answered.
Thank you.
Thank you so much.
All right.
You have
Thank
a
you
good
so
evening.
much. We truly
Bye-bye.
appreciate it.
Bye-bye.
Bye-bye.